Today I'm here and you're there. I was just talking to one of my followers, and he actually booked my time, so we came online to resolve his tax issues. And then he was telling me that he is a follower of our YouTube channel, so he hears 99% of what I do out here. So that's quite amazing. I am so pleased with the fact that we do provide useful information, and you really should treat us as one of your resources for understand taxes. And what I am showing you right now, it is the website. The website is communitycpa.com. When you come here, did you see that 10 best tax planning opportunities for 2024? That is part 1. Today, we're doing part 2. I selected 10. Of course, there's more, right? But this 10, the reason I select them, because it's most talked about. I want to make sure that I address those ones I most talked about, because that represents the client coming to our firm and the business clients, what may be most interest to you. So let's make sure that we knock off the other 5 today. Then we got our 10 total. So you have this link on our website to see the first one. You can also go to YouTube channel, folks. If you go to our YouTube channel, Community CPA, and you will see our channel that has all of these videos deposited in there. Let me pull up the channel for you. Not finding my mouse. All right. All right. So ladies and gentlemen, see, this is our YouTube channel, Community CPA. You go onto YouTube, you type our channel, subscribe to our site, because when you subscribe, you can click the little bell, so it tells you whenever we have new webinars getting deposited in here or getting started. It will remind you. If you just subscribe, you can come over here, literally search. So we got our first, right? So we will have this one deposited in here as well after today. So you have 10 total, the best strategy you need to use for your 2024 tax planning. All right. Let me get going with my PowerPoint, which I prepare our webinars every time. And not because we don't know what we're talking about, it's because there's too much to talk about. If we don't plan, it will be a time spent, then you don't have the focus. So I want to accomplish things whenever I get on the YouTube channel. I want to transfer that knowledge to you effectively, efficiently, simply. So hopefully you retain it. Even if you don't retain everything or every corner of understanding, you can still sort of refer to that when you talk to your tax preparer, right? All right. So about our firm, you know us, we're 27 years old firm, has more than 12,000 clients that we serve. We have 4 branches currently. The most recent opening is the Houston branch. We opened that up in July of this year. So right now that branch is operating. That made us 5 branches as of now. And our the CEO and the managing partner of the firm is me, Ying, and I served on this National Taxpayer Advocacy Panel, which is the Federal Advisory Committee to provide advice to IRS for 3 years. So need to brag about that so that you know where my technical levels is when we talk about taxes, right? I'm also an author. I wrote these 2 books. I have the 3rd, 4th coming up, 8 a.m., 10 a.m., 2 p.m., and 6 p.m. So I'll get that out for you on 2 p.m., which is how to expand your business. But the first 2 is how to start and how to grow. So you can tell that I'm trying to put together this know-how book about a business entrepreneur's journey. That's not everybody's cup of tea. It doesn't matter. You can still taste it and understand how that all involved. It's just fun to know how different aspect of life going on other than the one you have, right? All right, so no responsibility disclaimer, that's as always, and we want you to really be responsible for whatever you hear, and don't just trust whoever shows up feels like they're a big deal or feels like they're righteous. Don't we have enough example of people who shows up so righteous but lies every minute they talk, right? You got people who are running presidential elections like that, so just don't trust what's going on out there and do your own judgment. And you don't even have to trust me and the community CPA. Give us an opportunity to serve you first before you know whether you can trust or not. Am I right? I really think that is something our people need to be really careful. It is not enough warnings for people to get information out of the internet and not knowing right or wrong, and they're just falling to the wrong assumption, presumption, wrong information. All right, the first 5 tax strategy we talked about not last Saturday, the Saturday before. These are the 5. So if you like the topic but you don't remember what we talked about, go back to my website, communitycpa.com, click that 10 tax strategy video and watch that one. I would not repeat, but it is so important for you to know. The second 5 is what I'm going to tell you today, 2024 COVID planning, and a child tax planning, mother-in-law planning, business closure, and retirement saving. So let's get going. 2024 things related to COVID. And I know you are thinking, what, Ying? At this time of year, you still talk about COVID? Yes, I am, because there's still program open right now. ERC, a lot of people didn't get ERC money yet. So even though you didn't get ERC, you applied for it, I would recommend you to file amendment, because once you get it, you would have to amend 2020, 2021. The longer you wait, interest penalty and just accumulates, and there is no sure thing about whether, and you will get a you will get a waiver for the interest penalty that charged to you because it's not under your control, kind of thing. You can apply for the waiver, but it's not sure thing, right? So that is something I want to mention. I also want to tell you that right now rejection letters are coming out, and the IRS is rejecting your ERC claim. And I want folks to calm down and don't take the rejection letter as the final say. And we have seen in our firm, we have seen 3 rejection letters from client. They got rejection letter, felt like they would not get ERC anymore, and we reviewed their file. We look at the rejection letter. IRS absolutely wrong. I say that so clear. There's no debate about it. If we go to tax court, if we go to appeal, the taxpayer will win. So with those kind of rejection letter, folks, it's just a lot more work. It is more work for you, and it is more work for the professionals, but it doesn't mean you don't get it. So I just want to leave that there for 2024 consideration. So if you claim your ERC legitimately, properly, and you calculated everything right, you excluded all what you need to exclude, then you should get it. Okay? So that's just simple, straightforward. The other one I want to mention to you about is this SETC. So in this COVID-related topic, I just have these 2 to mention to you, ERC, SETC. And this SETC stands for Self-Employment Tax Credit. It's a significant financial relief program that is made available to self-employed individual, which means that if you were filing Schedule C, if you are getting Schedule E self-employed, those active, real estate business people, and then you are eligible for this claim. And here are the key details for that. So claiming time for 2020, the due date is April 15, 2024. So obviously we're passing that, but you still have 2021 that you can claim. That due date is not coming up yet. It's coming up to 2025, April 15. To qualify for SETC, the applicant must meet the following: self-employment, right? So you must be a self-employed individual, such as a sole proprietorship, independent contractors, or gig workers, right? The work from home IT folks who file Schedule C with your federal tax return for year 2020 and 2021. But some people are real estate professionals. You are filing Schedule E. You are eligible for that too. All right, COVID-19 impact, you must demonstrate you have that disruptions in your ability to work during the COVID-19 time. So these are four examples: being diagnosed with COVID and experiencing symptoms and needing to quarantine, or caring for family members who is affected by COVID, or school or daycare cancellation. So you have to stop working, taking care of your kids. The maximum credit can offer up to $32,220. All right. So I know I can hear the chit chat, but I know you are there. And if you go back to your 2021 tax return, you see yourself with a Schedule C on there, you need to go to talk to your tax professional and apply for SETC. All right? And I actually don't know anyone during the COVID time did not get impacted or disrupted by COVID. Just out of these four, I can't imagine the self-employed business people was not affected by COVID in these four ways. Okay, but if you are not, then you do not eligible for the credit. So do not apply. But if you apply, be ready to prove that was the case, right? All right, children's tax planning. Not too long ago, a couple days ago, I have a client calling, said that I have a 3 years old. I heard someone was telling me that I can deduct taxes out of them. I just bought them a toy car that cost me $1,200. I don't know how to, why people say that I can deduct. Why, how come I can't find the place on TurboTax to put that in? All right, so the children's tax planning, of course, involves you want to reduce your business income by putting money on your child, right? That is just a consideration that you want to make. But not all of it can be simply carved out, put on your child. Your child is free of paying taxes. So right here, I want to bring to you the kiddie tax rules, okay? For children under 24, because I included the one goes to university. But if they don't go to university, that's 18, okay? The kiddie tax applies to unearned income, like a dividend and interest, okay? That's kiddie tax applies to that. And the first $1,300 of unearned income is tax-free for your baby. The next $1,300 is taxed at child's rate. So what is the child's rate? You're going to use the form 8814. Typically is 0%. Okay? But once your income going over $2,600 and is taxed at parents' marginal tax rate. So if you're paying 37% of taxes, too bad your baby going to pay that rate. That is when you use form 8615. And this rule is crucial, okay, for families considering moving their investment onto their child name. We have clients who are doing that. Then when they come in, and instead of having taxes all filed on their name, they start kitty tax return. And on TurboTax, sir, gentlemen, ladies, on TurboTax, that kitty tax return, if you use their format to file, if you use their system to file, it's free. So you can actually take advantage of that, okay? And the tax filing consideration, you know how as a parent, your kids grow up, they're newborn, and you wish that they were born like right on December 31st that year, so you can claim a whole year child tax credit, right? And so as a parent, they're on our tax return by default when they are born. But at a certain point of time, this kid will have to leave your tax return to make that selection. To make that selection, whether you should take them or they should file on their own, and whether they should file on their own as a dependent, or they should file on their own as an independent kid. So those are the calculations your tax preparer should have done, should do for you. So if you have a kid are right on the 18 years old edge, and whether independent, dependent, they go to college or not going to college, there's a lot of switching. There's a lot of flexibility right there. So generally speaking, to make sure that if those tax credit your child is going to have, and they don't have enough taxes to claim it, you want them to be your dependent so you can claim their tax credit. Example would be tuition. And your kid is not making much money, but tuition is 2,000, 2,000. I wish it's 200,000. It's 2,000 credit, right? Tax credit. If they don't have the taxes amount they pay for 2,000, the credit will be wasted on their tax return, even though they're eligible to file it that way. Then you want to pull them back, put them as your dependent, so that you can claim that credit. Of course, sometimes we keep our kids on our tax return all the way to 26. Because of what? Because of the medical insurance. Because the kids, if they go out to get their own medical, is a lot more expensive than just being our kid on our medical insurance, because we already have them for 20-some years, right? So there's so many reasons for us to do these child and parent planning. The best advice I would give you is to know the complexity behind it and have all of your wish put together. I wish to not pay taxes. I wish to get their medical insurance. I wish to take over to have the tax credit that we can have. And Ying, tell me, are they going to be independent? Or are they going to be filing tax return as dependent? Or what do we do? So we will be able to tell you that. Every professional tax preparer should be able to tell you that. All right, that is so much as child tax planning. I know there's a lot more to say, and in the very beginning I mentioned about the clients calling and they want to pay this 3 years old, and the reason is that they're running a dental office. So the dental office has a commercial they put together, and using the baby teeth as a brushing the baby teeth as a little as a screenshot. So the babies are on advertising. Company decided that to pay the baby $3,000. So, is my client's tax can reduce the $3,000? So the baby gets the $3,000. Does the baby need to file any taxes for that earned income? So that would be a very, very technical question. It really depends on how your business is structured. This particular dental office, they're S corporations. So they're S corporation, and so the answer is no. But what if they are a partnership? What if the dental office was running as a sole proprietorship? Then the answer is yes. You see how that really affects how the decision is made? So good questions all around, but making sure you get the right answer and verify the answer and plan your 2024, right? That's why we are here today, talk about how to plan. Mother-in-law planning. I know folks are laughing about that, and it's almost like we don't have a good relationship with mother-in-law. What do you mean planning? I don't really want to know what to plan for them. And it is really not about mother-in-law. It could be your mom. It could be someone that not immediately related to your direct family, not mom and dad and children. This is like the relative right around your family, right? So a lot of time, the reason I actually bring this up on my slides because I have a lot of Asian clients, and you know that for whatever reason, I truly believe it's culturally driven, but I could be wrong too because I just don't know enough about other culture, whether that's the case. So in Asian culture, mother-in-law lives in the kid's family is very common. And my mother-in-law lived with me for 15 years. So, I used to, in the very beginning, of course, I am considered a Canadian girl at the time. So I told my husband that I didn't even know that after I married you, I also married my mother-in-law because that is just a very long time together. So my mother-in-law living in with us for 15 years. So now, how do you look at the mother-in-laws living with you and also take care of your children? My mother-in-law did an amazing job for taking care of my three children. I would say that if it is not her being there, she passed away already, but I would not have this career. I probably won't even have community CPA because there's no time. There's no time I can even work if I don't have her. So, she took care of the kids and she also lived here with us. So our clients have that situation a lot as well. So questions always come up. What if, mother-in-laws are living with us, so mother-in-law is giving us money to build, to decorate the room, to build a suite for her so she can live with us for a long time. So these are the questions when you come in to do your 2024 tax return. Your mother-in-law arrived, and you want to be super clear on these implications for taxes. So if mother-in-law give you money, that could be gift tax consideration. You know that mother-in-law can only give you that much, $18,000 per year per child. So if you are the child, and the mother-in-law will give you $18,000. But what if you build the suite, which is cost $180,000? So then you can't say that you got $180,000 gift from mother-in-law because gift tax do have tax implications, and she need to file gift tax return to document the money that she gave you, right? But what if you are saying that, well, who is going to account on mother-in-law? I am building her a place. I am going to let her rent my place. So how does that work? Rent space to mother-in-law? That way, you can deduct your building cost, you can deduct your expense, and you can offset the mother's income to you, right? And you got income, so you are eligible to deduct. The rental income you got need to have an agreement to back it up. And I would always say that, yes, of course, if you get audited, nice auditor come around, ask for, okay, your mother-in-law pays you. How much she pay you? Oh, $2,000 a month. Do you have a rental agreement? You go, no, it's my mother-in-law. I don't have one. Trust me, if it is a nice auditor, she'll be okay with that. But if it is not a so nice auditor, you don't have agreement, then you cannot deduct your expense. Imagine that. All of the expenses that you have for the mother-in-law and you can't deduct anymore because you didn't have that income in the agreement. And then worse, the $2,000 she pays you calculated into gift tax return. So don't let that happen and make arrangement. What about child care arrangement? So you want to pay your mother-in-law. Because when you do that, she get the money to pay you on rent. And you have the money goes out to her, then you can claim child tax care credit, right? So that is something you know that you can claim on your tax return if both of you are working. And of course, if your mother-in-law working for you, that can be considered a household employee. So you will run her W-2 as a household employee, and your Social Security Medicare is reduced. You don't pay the same amount like you pay for the employees at your company. With that, you see how mother-in-law comes in? So much good relationship you can have, but on the finance side, on the tax implication side, there's work to do. You can make this one be beneficial for you 360-degree, right? From the place all the way to the deduction of child care. But you can also make it totally reversed. Mother-in-law has to pay, and you also don't get a benefit. So that is the planning. That is how you plan to make sure that you are in compliance with what the government is asking. So, the estate planning side with the mother-in-law, I won't insert this one in just because when you do take care of your mother-in-law or your parents, and some social assistance the elderly get into, the government actually require them to pay back. So for that reason, you want to look at your mother-in-law's asset, you want to look at your family dynamic to start moving mother-in-law's asset to the children with time. Because mother-in-law can give $18,000 a year on gift tax, so that $18,000 maybe is 50% of the shares of the company that she has, right? So you want to start moving the money out to the next generation. So that is what we call asset divestment, like just really disperse them out, right? The family dynamic is important. You know what to do, and everybody is different. And I want to give you an example of how this payback things happens when mother-in-law passed away. So when the elderly passed away, during their lifetime, they probably, for example, they have a Medicaid assistance. And I want to show you my next screen. So the Medicaid benefit is subject to recovery. I'm just giving you one governmental example. This applies to both federal and state. So don't look down on this. If your parents are under Medicaid assistance, then like a nursing home, long-term care, and a certain hospital subscription drug service also can be free for them while they are using it, but after they passed away, it's all turned into dollars. So what they do is the government will send you a letter, and it will send the letter to the probate lawyers or to the family members and asking for reimbursement of those expenses. Of course, Medicaid can only recover up to the amount it paid for your mother-in-law. Cannot be more, and doesn't have interest charges, has no penalty charges. It's just exactly what costs the Medicaid to do the care. They recover from your probate estate, that includes the asset solely on your mother-in-law's name, on your name. So if you are the one getting the Medicaid, you know that every property is going to be looked at. They want to know that after you sell it, how much can you pay Medicaid, right? Of course, if there's nothing to recover, the case closed. It's not like if your mother-in-law don't pay, then you ended up paying. No. But some state have what we call the expanded estate. So they will go after the joint ownership. Maybe it's not your mother-in-law, but could be your father-in-law. All right, so I just want you to when you do these type of tax planning, you really, really know what tax implications is and what your mother-in-law have, how she live with you, and you want to plan that out. It is a good time this year to do it early, and don't wait until mother-in-law already live with you for 15 years, and that's not a good idea. So just do it from beginning. All right. Now, our third one is business closure planning. And you may be wondering that, what kind of planning I need? I'm not doing very good. Business is going south. I'm just closing it, Ying. I don't need any planning. No, you do. In business, I tell folks that there is no loss, so-called loss in business. The losses you have in business can come in to offset your W-2 income for next many years if you don't make more money. Have you heard of President Trump doesn't need to pay income tax? Yes, because the rumor mill goes he has $945 million losses on his personal tax return, and unless he makes $945 million gain, he will never be using it up. Who knows? He got a lot of campaign donations, so maybe he is using it up. He's going to be reporting that as an income, so it will offset. I'm just kidding. Those are not really going to land on the 1040. But I want to make a point to say that if you have a loss, if you treat these laws properly, they come to help you to eliminating or reducing your tax liabilities. So I want you to calculate the gain and losses from the closure carefully. And if someone just tell you that, you lost, and don't worry about it. Oh, that is because these people didn't quite understand yet how the loss works in our tax system. And if you sell certain business, you may qualify for $10 million gain exemption. How could you not plan that, right? So you really want to plan that and ask, hey, can I get $10 million exemption? Like when I sell my primary residence, I got $500,000 exemption, right? So do I have the 10 million? Ask those questions. People would have to answer that for you. And then we also want to tell you that you want to settle your debt and settle your liability. And when you close the company, for settling debt, that is an opportunity for writing off profit, right? If you have a debt that if you have account receivable, the debt you extended to other people, they're supposed to pay you back. And on your business book, you have $100,000. And you know that you're closing your business because this person don't pay you back. You're short of that money. That is a write-off that can help you reduce your taxes. So liability, if you cancel your liability, you have extra income, my dear. So you don't want to close your eyes just not to do anything because you're going to get a 1099-C one day or next year one day, because people who let you go with a debt cancellation will issue a 1099-C. So important, right? You want to settle that first before you do closure. Then you want to cancel all of these things I'm talking about. Number 1, dissolve your business with SOS. Number 2, cancel your license permit. Number 3, do not cancel. Close your business account right away. I know people tell you to close that right away. No, you don't, because you're going to get money back from the government. And if you close it properly, so keep your bank account open for at least 6 months. Of course, for closure, and you want to keep your record, and you want to keep your record for how many years? 7 years. 7 years. All right? And maintain this document with you, because you just don't know what potato is going to show up and wanting to be grilled. You know what I mean? So you want to make sure that you keep your document. And the tax implications of asset. And did you hear my YouTube channel related to how to calculate capital gain? So important. I want you to go back to that YouTube video and listen to that. And the recapture gain is always a surprise. People get surprised. People go, I bought this thing for $1. I sold for $5, and so I have $4 capital gain. What do you mean recapture? What do you mean? And recapture, because that $1 is a recapture gain, and only $3 is your capital gain. So capital gain is a lower rate. That $1 recapture is ordinary rate, or maybe recapture for lower rate like 25% for 1250 section for 1250 treatment. But it's really to really summarize that up, it is a place where you do not want to trust your math simply a number minus another number goes, that's my taxes. I use that number, tax 20%, that's my taxes. No. You have recapture. All right? So I want to leave that there for you so you know when you close the company, there are so many things that you need to do, not as simple as just close, right? Plan that. Plan that for 2024. Our last one, but not the least, is retirement saving. I want to impress you with that just because sometimes you feel like that's really far away from you. But if you made money in the year, in 2024, right now is such a good timing to get the retirement set up. So I use 2 retirement plans, which is the most popular one we have on the market for small business owners. One is 401k, the other one is SEP, IRA, Simplified Employee Pension Plan. So now let's look at our 401k. I put it in here for you. So what to remember is 401k has 2 portions. One portion, they call that deferral. Contribution limit for 2024, the employee can contribute up to $23,000. Age over 50 is $30,500. So what does this paragraph mean? If you remember, we get W-2, am I right? So on the W-2, have you noticed the box 3 and the 5, sometimes the number is not the same as a box 1. If you do contribution like that, your taxable income, the box 1, will reduce by this amount, which means that out of your W-2, $100,000, and the $77,000 you will pay income tax. The other $23,000 got saved into your 401k plan. You don't pay taxes right now. You only pay when you get older, you take them out, right? So folks, I am a tax person. I know financial side of world really well. And at a community CPA, we have our wealth division. So we do financial planning side of things with our licensed planner. But conceptually, your tax people and your financial planner never think the same. Your tax people is focused on saving taxes for you for today. Frankly speaking, we don't know what 2025 looks like. And there's some roadmap out of the 2025 by Republicans, by MAGA Republicans, and it paints very different picture. But you also have existing system that is going forward as normal, but you yet also have a new leadership maybe coming into the White House and will have some innovation to do related to retirement side of world, right? So much change. So what do? When the world is very flexible to change and you focus on today, if you can save $5 today, you don't wait for 10 years, 20 years later to save 50. Just forget about that, right? That's why I care about you for saving right now. You may say that, I put away $23,000, but what if I don't make money? Then I lose the opportunity to make a lot of money, so I probably should do something else with the money. What you say is not wrong, But what you say is also says that you are projecting. You're projecting alternative ways making money and it would be bigger than your tax saving. If your tax rate is at 37%, 40%, your 23,000, that is almost $16,000 saving on taxes. It's not a small saving. It is something that you want to know and to save today and don't wait for tomorrow. And the other big piece on 401k is this employer contribution. Employer contribution, the employee can match employee's contribution or simply put in contribution. The maximum is 66,000. If you're 50 over 50 is 73,500. So I want to put this into a concept for you. Earlier we just talked about your W-2, but this employer contribution is actually an expense for the company. It goes to your account. So let's say an example, small business, 2 employees, husband and a wife, $100,000 each. They pay themselves W-2, $100,000 each. They don't have other employees, just 2 of them. And both are 40 years old, so they are not 50. They don't have the catch-up amount. So 23,000 they can put away. So 46,000 total. They don't need to pay taxes. Now, 25% of 100,000 is 25,000. So 50,000 again, company write a $50,000 check, and it goes to say Fidelity, and then you got 46,000 plus 50,000, 96,000 total. Goes into Fidelity under the business owner's name, 401k. Saved $26,800 taxes. I was using 26%. I didn't even use 40%. Okay, so with that, you can see the saving part of it, right? So the only hurdle, the only roadblock you have here is how to set it up. You can come to Community CPA, we help you. Okay, you can go to your trusted financial advisor, they help you, but you just need to set it up. SEP plan, IRA, and it's a retirement plan as well, but this is only employer contribution. So if a husband and wife, just like what we said, employer can do 25%. So in this case, it will be what? It will be 50,000, right? It's 25,000 for each because they pay their W-2 for 100,000. So that is how that is calculated. And very flexible. You can do it at year end when you know you have money. So it is a win-win situation. When you make money, you do not want to pay taxes, but you want to do some good for your future. That's what you do. When setting up for 1K plan, small business can benefit from several tax credits. I want to bring this in just because it's not even just about the $26,000 I was talking about saving you taxes. There's more. There is more. Everyone misses it. Everyone misses it. Because when you do that with a financial planner who doesn't do taxes, they don't really know to tell your tax preparer that, hey, there is a new setup, there is a tax credit this guy can have. And you also don't realize that is something you're supposed to get, so it's get missed out all the time. So now with this webinar I have, and I will say that none of you gonna miss these 3 credits. 3 credits. Startup tax credit. If 2024 is the first year for you, you're gonna have it. So up to $5,000 tax credit. You know what means $5,000 tax credit? Means that reduce your income by almost $200,000. It's a big deal. It's not a small potato. It's a big one. All right, so set up tax credit. Then the other one is automatic enrollment tax credit. And what is automatic enrollment tax credit? Which means that when you have your plan and your employee, as soon as they're eligible, they automatically enroll. And you're treating everybody the same. Every employee has opportunity to be eligible. And that is something the government encourage. They say that if you do that, we give you a 500 tax credit for each of your first 3 years automatically enrolled features in your tax return. So you just need to file that form 8881. More, employer contribution tax credit. This credit is available to small business with less than 100 employees. And the employer provides contribution to their employee retirement account. Okay, the employer, the boss, can receive a tax credit, which means the company receive a tax credit for up to $1,000 per eligible employee. Earning $100,000 less means their W-2 need to be $100,000 less. So if they are less than $100,000, company putting in the money for retirement, and that credit is available for the company. The credit is phased out for business with more than 50 employees. So if you're not over 50 employees yet, you have that. All right? So claim Form 8881 to claim all of these benefits. So don't forget. And that is something should be on your tax return if you started retirement saving plan. If you did with community CPA, of course we do that. It's just automatic for us, right? But if you do your things separately, you have financial planners, you have your tax people, they don't necessarily connect. You just screenshot of this video, these pages, and make sure include that in your 2024 tax return, have them figure it out, right? So it's a 3 years, there's a limited time, so make sure you do that. All right, that gives the number 5 planning strategy for 2024. And you know how to get hold of us on the Community CPA website. There is an appointment button. If you click, you see me, you see Dr. Hao, you see Dan, Song, Kwon, Derek. And we're all specialized in different things, and you can pick out who knows what, and then decide on who do you want to meet. All right. Last but not the least, I want you to know that our YouTube channel is just so useful. And go ahead, subscribe to our channel. And that's our website, right? You know that I showed you. Catherine at communitycpa.com. She is the organizer behind all of these. So you see me here is because she reminded me and she put out the slides for me. And there are times I don't even need to change any of the slides because it was so well done. But there are also times I do add up and subtract, but Catherine did all the groundwork. And I talk about the genius, right, in knowing social media, know what people need. So we have a lot of folks who listen to our YouTube channel actually email Catherine to suggest what topic they'd like to hear next time. So we try to keep all of you content and happy. So if you have a request, we try to come in to do that. So call this number. We open 6 days a week. Yeah, we work regularly on Saturday. So no stranger to working on Saturday for myself. So you can contact us and we'll be there for you. And September 15 is a company pass-through entities due day. And if you have fiscal year schedule, fiscal year C corporation, that might be the due day as well. So make sure that you file your tax on time, okay? And we call all of our clients who file their tax on time are good citizens. And the one who doesn't are yet to improve citizens. But at the end, everybody is a good one, all right?